following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is Esther Gulius, and I don't know who I am. I'm the tax lady, that's who. And I'm here in studio with Tiffany Fabian. We're out of the office.
It feels so good.
It does feel good to be out of the office.
It's like a little tease. I'm like dipping my toes in the lake.
All right, and we are here to help you with your taxes. Any questions on filing? Do you have to wait for the 1095 A, B, or C? W-2s, where the heck are the refunds? Are the IRS going to process returns? What can I do to make sure that they don't hold up my refunds? We want to help you. 803-0930, 803-0930, star 930 on a cell phone. And if we get a chance, I've had this for 2 weeks now.
Right.
We'll tell you how your tax return is actually taxed, which is, I think, pretty interesting, don't you think? Like, for instance, when a lot of people don't even understand that, you start off with your gross taxable income, and then after that, you reduce it by a bunch of things to come up with your taxable income. So, for instance, you either have standard deduction or personal exemption. You have either standard deduction or personal exemptions or itemized deduction, and then there's a bunch of other things that are deductible, like business expenses for performing artists, armed forces and reservist expenses, educator expenses, health savings account deductions, moving expenses, half of your self-employment taxes, SEP IRA simple plans, self-employed health insurance adjustments, alimony paid student loan interest, tuition and fees, and that's just before you get to the itemized deductions. So you start off with the income, take the adjustments, take the standard deduction personal exemption, and that's your taxable income, and that's what you're taxed on.
Yeah, and it's so many people are like, okay, so I'm in the 15% tax bracket, and so all of my income is taxed at that. And I'm like, no, it's your taxable income, which is what you were just outlining there.
Right. So somebody could start off with income of $70,000 and have an SEP, for instance, or a simple plan, and have student loan interest, and have itemized deductions and personal exemptions. And what really gets taxed isn't the 70, it might be 40.
That's right. And that's difficult to understand.
And that's where you go to find out your tax bracket. And so that amount of money is taxed. And then from that, you reduce it by credits.
Right.
So the American Opportunity Tax Credit, the Lifetime Learning Credit,
the energy credit,
and so
retirement credit,
child tax credit. So you can start off with after taxable income a tax liability of $4,000, but you have 4 children under the age of 17. That'll wipe out your tax liability altogether. And so, I just thought it was important for people to see how their taxes are computed. So I'm Esther Gulius, the tax lady. I have that buffalo cold and I cannot get over it.
I have so many clients.
It's settled in my throat. So anyway, 803-0930, 803-0930, star 930 on a cell phone. Let's go to Mr. Nick. Hey, Mr. Nick, how can we help you?
Hi. Student loan.
Yes, sir.
Can I write off the interest that I paid?
Maybe. How much is your income?
Income's about $44,000.
Okay. So and it was your loan paid with your money, correct?
Yes.
All right. So the first $2,500 of interest would be deductible.
Okay, that's all, huh? Okay.
That's it.
And then, of course, it helps the state too.
Right.
Oh, okay.
Okay, Nick?
That's I need to know. Thank you.
Thank you, sir. Bye-bye. Yeah, and there's a phase out. So your student loan deduction starts to phase out between $130,000 to $160,000 if you're filing a joint return, $65,000 to $80,000 if you're a widower, $65,000 to $80,000 single or head of the household. So
or if
some
you
people,
do married filing separate. you can't take it.
That's right. A lot of times people don't realize that even though the student loan interest is potentially deductible, if you make too much money, you lose the deduction.
And that's why you asked Nick how much he made. At 40, it sounds like he's okay.
He's absolutely
and
fine.
it's sad.
Unless he's married separate.
Right, and it's sad. I'll have people come in who've paid $4,000, and all they can deduct is the $2,500.
Yep. That or 12. I had one the other day that paid like $8,000 in student loan interest, but they could only take $2,500. Okay, let's go back to the phones and talk to. I don't know who this is. Can I help you?
Hi, my name is.
Okay, I'm sorry. Let's see. Let's try this one. Hey, Larry.
Hey, Esther, dear. Hi, how are you?
Good.
Good. Listen, I wanted to call you early because I'm kind of perplexed.
What's wrong?
It's about my IRA. Here's my situation, Esther. By the way, Esther, I want to get a picture of you too.
I looked for it the other
Larry,
day.
I have to tell you, I got that picture of you, and I just was so impressed because you look like such a wonderful guy.
I am a wonderful guy.
You are a wonderful guy.
So modest.
So I'm keeping it in my office in case I've got Miss Wright coming in, because believe me, you know me, I love to matchmake.
I know you do. Okay, so let me talk a little business. So Esther, dear, at my age, I don't expect my income to decrease when I die. It's going to remain about the same, unless the market crashes. That's one. Two, Esther, right now I'm living off my savings so I can kind of spend down some of my cash. Three, I have a standard IRA. I have to take RMDs from. I have to.
Yeah.
That IRA has about 100K in it right now, roughly. Then in addition to that, I have my own SEP IRA, which I'll start taking withdrawals when I reach 70 and a half.
Right.
That one has about 30K in it.
Right.
Now, I wonder, is it possible and practical to convert a portion of a standard IRA into a Roth? That's one. Two,
Okay, but remember, if you convert it to a Roth, then it's going to be fully taxable upon conversion.
that's what I'm asking.
Okay.
Do I have to convert the whole thing? Or
No, you can do anything you want, but if you do a Roth conversion, all the money you move from a traditional to a Roth is going to be taxable up front, which seems to defeat the purpose because you don't want to pay taxes, but you're going to pay it all up front when you do the conversion.
I guess I would ask, when I pay the taxes on anything I withdraw from the standard up front, when I withdraw it anyway?
You mean when you withdraw from a Roth?
No, dear. When I withdraw from my standard IRA.
Yeah, you will.
Yep.
You
You're
will.
going to pay.
But you see, Larry, let's just hypothetically say you wanted to roll over $100,000. You're going to pay taxes on $100,000, and it's probably going to cost you $30,000 in taxes. Okay.
Yeah.
But if you had it and you did the systematic withdrawal, then you're looking at maybe $6,000 a year at your tax bracket, and it's $1,800 in taxes. So I'd rather pay $1,800 than $30,000.
What Esther is saying is if you take that big glomp and you switch it over to a Roth, you're paying the taxes up front instead of little bit.
Gals, if you understand it. Okay, let me go on then. So I was thinking maybe two things. One, I'm looking for some cash flow. I have to take that RMD no matter what, right?
Have to.
I was thinking
At 70 and a half, you have to do it.
Well, no, I'm taking the RMD on the one that I have right now.
Well, an RMD, Larry, means required minimum distribution. It means you're 70 and a half. You're not 70 and a half.
No, darling.
But maybe he wants to lower the portfolio so it makes it easier when he reaches 70 and a half?
No. Let me explain. I have two IRAs. I have an inherited IRA, right?
And
right.
You have to.
Which you have to take over a 5-year period or annuitize. Okay.
Right. I'm doing that right now. That one has about 100K in it right now.
Okay.
Then in addition to that, hon, I have another one, my own separate
30.
that has 30.
Yeah.
So up to this point, I've just been taking the bare minimum RMD, which is about $5,000 a year.
Yeah.
Right.
Yeah.
And so I was wondering, would it kill me if I maybe increase that maybe to 10,000?
Okay. You know what I'm going to do, Larry, because I got a break for take a break. What I'd like you to do is, why don't you call me and call the office? They'll give you my cell phone and we'll talk in person, okay?
I'll hold on, darling.
I'll
All right.
email you.
All right, thanks, Claire.
Bye.
All right, bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We got Bill and Mike and Catherine on the line. We're going to take a short break. We'll be right back. Hey, this is Esther Golias, the tax lady, and this is tax season, and we want to help you. 8030930, 8030930, star 930 on cell phone. We're going to go to Mike. Hey, Mr. Mike, how can we help you, sir?
Hi, Esther. Thank you for taking my call.
Yeah, what can we do for you?
This is the first year of my retirement.
Yep.
And I received my 1099-R from my lifetime retirement annuity.
Uh-huh.
And I'm a little confused about identifying the amount I'm supposed to put on line 16 of Form 1040.
All right, tell me what box 1 says.
Okay, box 1 says gross distribution.
What does box 2 say?
2A says taxable amount.
And all right, is 16A is the box 1, and 16B is the taxable amount.
I'm sorry?
Box 16A is the gross amount, and line 16B is the taxable amount.
Okay, I understand. Now, but my other question is, on box 5 of the same form, there's an amount listed under employee contributions of $141.60.
Mm-hmm. Well, that's why box 2 is lower than box 1.
Okay, and then one final question. Box 9, total employee contributions. This was a 403B plan, so all funds were pre-taxed, so I don't need to consider any of that amount.
No, it's already been done for you.
It's already been done. So then do I just go ahead and figure my taxes by putting in 16B?
You put it, 16A is the gross amount, 16B is the taxable amount.
Okay, and that's it. I don't have to do a simplified method?
Nothing.
Nothing.
Yeah, that simplified method is seeming to drop off. That was a different tier.
Right,
and now,
actually, it's general rule now. So, but you don't do the computation. They already did it.
it's all phased out. I think I don't see any more of those.
Okay, it's new to me. That's calling.
Okay.
My favorite aunt was named E.G., by the way. Good luck. Thank
Oh,
Thank you.
Welcome.
Bye bye. Let's see. Let's go to Catherine. Hey, Catherine, how can we help you?
Hi. I have a daughter that's 20 years old that's in graduate school getting a PhD, and she does not live with us. However, she takes out the loan for grad school, and we pay for everything else, from the apartment to food, utilities, to her cars.
Mm-hmm.
Well, what we're wondering is, can we claim her?
So first of all, Catherine, how old is she?
22.
22.
All right, she's 22, and she's in grad school, correct?
Yes.
Is she in her own apartment?
Yes.
Is she in her own apartment because she's self-sufficient, or is she there temporarily while she's in school?
No, she lives there because she goes to school in the city of Buffalo, and it's an hour each way for her to go to school.
All right, so she's living there because she's going to school, right?
Right.
Okay, so let me ask you another thing. How much does Catherine, your daughter, make?
She doesn't work at all. She's getting a PhD in pharmacy, so she's not working at all.
So she makes no money?
No, zero zilch.
All right, so she lives in an apartment that you provide, and she's in grad school, and she's under the age of 24, and she has taxable income of less than $4,000.
Yeah, she's got no income other than what we give her.
All right, then you can claim her.
We can claim her.
Uh-huh. And you would also claim lifetime learning credit.
Okay, we were wondering that because the graduate student loans we've taken out is about $40,000 per year. That's about $20,000 a semester. And we didn't know if she had to do anything.
No, she has no income. She's your dependent, and you can do lifetime learning. She doesn't have scholarships, right?
No, in grad school you get nothing.
Yeah, so that's pretty good news for you.
Okay, so it's called lifetime.
Lifetime learning credit.
Okie doke.
And well, hopefully you did it the year prior
You
too.
did it
if it
the
was
other
the
years, right,
same
Catherine?
situation.
No, this is the first year of grad school. She started in September.
Did you claim her last year?
Yes, I believe so. She lived at our homeless.
good.
Well, it's not. You see, children can be out of the house for a temporary absent while they're at school. That's not a problem. Okay? So whether she was in your house or whether she was in college, while she's at college, she needs a place to stay at college. She can still be claimed as a dependent if she's under the age of 24, is a full-time student, and she's not furnishing over 50% of her own support. So, yeah, she's good.
Okay.
All right?
So much.
Thanks, Catherine. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on the cell phone, and we're going to go to Bill in Depew. Hey, Bill, how can we help you?
Hi, Esther. Good afternoon. Thanks for taking my call.
Yeah.
I got a question here. My sister had worked for the state about 9 years ago, and they sent her a letter where she had to take the funds out of her, I think it's a 401k, and she actually took the check and cashed it back in August. Is there a way she can restore that back in an IRA or 401k so she don't get the tax bill?
You have 60 days to roll it over, and so back in August that was too late, and so there's nothing she can do to restore it. So unfortunately, it's going to be taxable. The good thing is it sounds like it was from the state, so it'll all be tax-free on New York.
Oh, okay.
All right, but let me ask you this, Bill. Is she working?
Oh, yeah, she's a teacher now.
All right, so this is what she can do to help mitigate part of it. How big of a distribution was it?
I think she said 4,000.
Okay, so what she should look at is putting money into an IRA.
But I think she's covered by a qualified plan.
Well, it depends on her income.
Depends on her income.
So do you have any idea how much her income is?
That I'm not too sure about.
Okay.
Is she married or
is she
single?
Or married, yeah. Is she single or married?
Oh, she's single.
All right, so if her income was under $71,000, and even if she's covered under a qualified plan, she could put up to $5,500. I'm assuming she's under the age of 50.
Oh, she is.
All right, she could put $5,500 in an IRA. So she'd have that distribution from the 401k up in box 16, line 16, but under the adjustment sections, she could put money in an IRA, and so the two are going to offset each other.
Now, there's one other question I got. She, with her teaching job, she could buy into that. Like if she had, I think it's $6,500, then she'll be able to get vested quicker. And there's a lot of benefits to doing that. Would that count just like an IRA, or is that something?
No, that's something different.
Okay, so that wouldn't help her out.
No, but if she put money in an IRA, the money that she's concerned about, she's really offsetting with the new IRA.
I got you. Okay, well, I think you answered all my questions.
All right, thanks, Mr. Bill.
Have a good day.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 803-0930, 803-0930, star 930 on your cell phone. And all of our offices are open tonight till 9.
Till 9 o'clock. Yep.
We are closed on Sunday except for our two mall locations.
That's right, which is the Niagara Fashion Outlet Malls and the McKinley Mall. So if you still need to get your taxes done tomorrow, they can help you.
That's correct.
That's
so they're
right.
open on mall hours, I think. What time they open? 12 to 5?
Yes.
Right.
Yep.
And again, if you ever have a tax question, you can go to our website at egtax.com. There's an Ask the Tax Lady button there.
Actually, I think the mall's open at 10.
Okay.
Yeah.
And you just click on, and you can email me any question. I'm happy to answer it anytime. You know, and I try to keep up on everything as busy as we are this time of year, and we want to help you. So, but this week we have seen some bizarre things. We've had people that have come in and they've taken American Opportunity Tax credits when should have taken Lifetime Learning, and that was a problem. I had a family in this morning where the daughter came in and they kind of sat there and they said, "Okay, prove to us that the American Opportunity Tax Credit should be taken by the parents." So I did the girl's return first, showed her how much her brief was. Then I did mom and dad's, and mom and dad made out about little over $2,000 better than she did. Everybody was happy. They're going to pay the daughter. Right. So, okay, let's go back. Well, do I have, what time is the news? 30? Yeah, okay. I'm going to keep talking until the news. But on the other side of the news, I got Jimmy, Rob, Arlene, Mary, and your calls. And again, if you need any kind of tax help, EG Tax can do, if you're Canadian or if you're a U.S. citizen, if you're somebody that has to do an FBAR, if you're a U.S. citizen with income over in Canada,
Yeah,
we can help you with that too. And we're going to break for news. We'll be back on the other side with your calls.
That's the lady with the big blonde hair. Lady with the big blonde hair.
Yeah, who is that?
Stevie Nicks.
Stevie Nicks. And by the way, there was one of my clients who came in who wanted to tell them to play a song, and I forgot to bring the name. I'll bring it next time.
All right. Well, I'm Esther Gilius, the tax lady from EG Tax, and we want to help you. And so I'm going to go to Rob, who's waited so long. Hey, Rob, how can we help you? Rob, he probably fell asleep.
Oh, I'm sorry.
See, he probably went to the potty or something. Hey, Rob.
Oh, I'm back. I'm sorry.
That's all right. How can we help you?
Okay, I've got a question about charitable contributions.
Yeah.
I inherited a house in 2015, sold it late in 2015, and did a tithe on it at the beginning of 2016. So
okay.
Up last year.
Okay.
As a matter of fact, I'm unemployed now. That added into my normal tithing and giving, I won't need all of those charitable contributions in 1 year. Is there anything I can do to spread that out over?
Yeah, well, what you do is there's a carry forward. Your maximum contributions that you can give when you're giving cash is 50% of your adjusted gross income. So if your adjusted gross income is $30,000, the maximum charity you can take would be $15,000. If you gave $18,000, $3,000 carries forward to the next year.
So what Esther's saying is put it all on the return that you were supposed
That's
to.
Right.
But
or amend it because you're talking about 2015.
No, but he paid the tithe in 16, right?
I paid the tithe in 16.
Right. So let's do real numbers, Rob. How much money did you make in 16 approximately?
Approximately. I haven't added the jobs up.
Yeah, but
like 38 maybe.
Well, let's say 40,000. All right? And that means that you can take charitable contributions up to 20,000 if they're cash contributions.
Okay.
And if you did 25, that means 5,000 is going to carry forward to next year.
Am I forced to take the full 20 if that doesn't?
Yes, you are.
Can I elect to carry?
No.
Some.
No.
No.
No. Only if it exceeds the maximums.
Okay, so if I'm using some kind of software to do taxes, that'll probably.
It'll do it. It should do it automatically for you.
Okay. Okay.
Thank you, sir.
And don't forget
Bye-bye.
that house that you inherited gets a stepped-up basis.
He did that on 15.
Oh.
He sold it on 15. Okay, let's go
You're
to
right.
Arlene. Hey, Arlene, how can we help you?
Yes, I'm a senior citizen. I'm on Social Security, and I have two small pensions. I had the opportunity to go to a casino, and I happened to win $800 and some odd dollars.
Yay.
Yes, but now I'm being told that they didn't take taxes out of that.
Mm-hmm. Okay.
That it's income.
Right.
And people are saying that if it's over 1,000, you don't have to claim it.
No, that's not true. Every dollar that you get, unless it's specifically exempt, is taxable, okay? One of the bad thing about winnings, gambling winnings, especially for somebody that's on Social Security, is that it's a line 21 item on the 1040 form, and it makes your Social Security more taxable. The only place that you can offset those winnings is if you itemize, and on your itemized deduction, you can take losses up to the winnings if you incurred those losses. So many times, seniors get El Shaftoloed, if you understand.
Do you usually file a tax return, Arlene?
Yes, I do.
Okay.
I get taxes taken out from one of my pensions.
I wasn't sure if you said you had two small pensions.
So anyway, you're going to be it will make your Social Security more taxable.
Oh boy. Okay, now do you know about how much taxes they would?
I don't know, Arlene. I have to look at your tax return. You know, so it's not like they're going to take taxes out. You're going to possibly owe taxes when you're done with the return, and it makes, like I said, it makes your Social Security more taxable. If are you single or married?
Cent?
Are you single or married?
I'm single.
All right. So, do you have other forms of income? How much is your pension approximately?
Well, altogether, if I get my pensions and my social.
No, I want to know how much your pension is.
Oh, about $100 I have two of them for $100 a month.
All right, so the total is 100?
Yeah, no, well, the total is $220.
$220 a month, right?
Yeah.
And then the rest of it's Social Security?
Yes.
Okay, you don't have a problem in the world.
File your return to get your withholdings.
You're just going to file your return to get your withholdings. You're under the minimum standard.
That's what I was thinking.
Standard deduction. You don't minimum amount before you have to file a tax return. So you file to get your refund back from your withholding and stop your withholdings. You don't have to file a return, Arlene.
Okay, so if I stop my withholdings, that I even have to file a return next year?
That's correct.
See, that's one of the things I was asking, too, and they didn't give me an answer. Okay.
But the fact is you've stopped your withholding partway through the year, so you're still going to have to file for 2017.
Little teeny refund next year, but you stop it Monday. Call and stop it, okay?
Yeah, I can use that money during the month, that's for sure.
Yeah, okay?
Awesome. Okay, great. Thanks you so much.
Okay, Arlene, bye-bye. Yeah, I'm thinking I'm giving her all this stuff. She doesn't have to file. Okay, let's see. We're going to go to Mary in Akron. Hi, Mary.
Hi, how are you?
I'm marvelous.
Good. I was something online about Obama had signed something in the past about giving anything you spent in sales tax back to you as a rebate.
No, the sales taxes are an itemized deduction. You can either, when you are an itemizer, you can either take the sales taxes you paid during the year or the state taxes that you paid during the year or had withheld during the year, whichever is greater, and they don't come back to you. It's an itemized deduction.
Okay, so it's either or then.
Either or.
And that's
The
been
bigger
around
one.
for about 10 years, so it wasn't an Obama thing.
No,
I mean,
actually, it was. I think it was instituted during the Obama administration. Yeah, I'm pretty sure.
It's been a long time.
But they kept extending it and extending it
Right.
and extending it. Yeah.
Okay. All right.
Okay, Mary?
So much.
Thank you. Bye-bye. I'm Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. And we're going to go to, let's see, who's been on longer? Jimmy. Mr. Jimmy, how can we help you?
Hi, Esther. How are you?
Good.
Yeah, I got a question. So, okay, last year I was working for in a restaurant and stuff like that.
Okay.
And then this year when I'm going to fill my tax, because I always fill my tax on EG Tax.
Oh, thank you.
When I call him to ask him for my W-2, and then he said, "Oh, I don't have any W-2 for you because when I used to pay you, I used to use QuickBook."
Okay.
So he's supposed to give me a W-2.
Okay. All right. So is he saying that he just paid you in cash? Is that what he's saying?
Yeah, he pay you in cash, and then after that he call paycheck. He give the payroll, and then the payroll they send the pay stub. And then when I ask them for my W-2 for this year, for last year, he say he doesn't have any W-2 because he used QuickBook.
Okay. So you have an option, and there's a form that we can fill out that if you know how much you got, we can protest the fact that they didn't pay you properly on a W-2, and they will go back to that employer and they will force him to pay the FICA his portion, the employer's portion of the FICA. And when you go into the office, we can help you with that. So not to worry, Jimmy. Just make sure you come in with the right amount that you earned from this guy.
Okay, all right. Thank you so much.
You're welcome, Jimmy. Bye-bye. Yeah, because there are people that are being paid in cash, right? And so the owner gives them a 1099 form, which is, and it
didn't
employed.
matter if he was using QuickBooks. That didn't
right.
matter.
Yeah, QuickBooks, whatever. I use QuickBooks, but we still have a W-2.
Right.
But anyway, and so the employee gets a 1099, which means the employee doesn't get unemployment, and he has to pay his own FICA and all those kind of things that an employee should have to do. If you're in that situation and you, just like Jimmy, you were supposed to be paid on a W-2, you can protest that. There's a form that allows you to eliminate the employer portion of the FICA on your tax return. It kind of blows in the employer, but they should be blown in.
That's right.
Because that's not right.
And you're doing the right thing.
Right. Okay, let's see. We're going to Michael. Hey, Mike. How are you, sir?
Hi, yes, how are you doing?
Good.
I got a question for you. My wife and I are going to be filing a joint return for last year, and our gross income is like $150,000.
Okay.
I'm retired, she works. Our income's about split. Can she file a traditional IRA, or is her income, will the income be too high?
Do you have a qualified pension plan?
I'm retired. I'm on a qualified pension.
Okay, but does she have a qualified pension plan?
She's got a qualified pension plan and a 403B.
Okay, so you cannot put money into a traditional IRA and take it as a deduction if you're filing a joint return and your income exceeds $118,000.
I was thinking married filing separate might be better for you for this year if your income's about split and you're at 150.
Well, then you can't. Then they.
I know,
really
but
can't.
they can't put money in. So
Yeah.
then.
So what Tiffany's saying is, on another genre, another thing, is maybe you guys should look at married filing separately, because
your
married
income-
filing separately might do you better than married joint.
If your income
Unless
is
you have
equally
children. You have
yoked.
children at home anymore, Mike?
No.
Yeah. Look at married separate, but the traditional IRA is not going to work.
Okay, great.
Okay?
Thank you.
Thank you, sir. Bye-bye. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to go past this break here, and we're going to go up to 3 minutes before 4, because we're going to get out of here so I can get back to the office. So if you have questions, give us a call, 803.
And don't forget to answer the lady who texted
and that's
you.
right. We got a, what is that?
A text
Is that
or
a text?
something.
Esther, is there a minimum amount of wages that requires you to file taxes? Thinking about my 18-year-old daughter. Thanks. Okay. So there are minimum amounts before anybody has to file taxes,
Correct.
right? But many times you want to file taxes. So the daughter has to file taxes if she has wages of more than $3,000.
Right.
Because
of New York.
Right, because New York standard deduction is $3,100.
That's right.
So at $3,100, she has to file, okay? But if she has withholding, this little girl might have $150 in withholding, and she wants to file because
She'll get it all back.
$150 to an 18-year-old is a lot of
Yep.
money.
Yep.
So she might not have to file, but she wants to file.
Right, and she's going to indicate that she's a dependent on your return when she files.
That's exactly right. All right, let's go back to the phones. We got Eric. Hey, Mr. Eric, how can we help you, sir?
I have a question about income limits for claiming student loan interest.
Yeah.
So my wife and I, we filed jointly. We pay about $7,500 a year in interest for student loans.
Uh-huh.
Is how much of that can I claim?
$2,500.
That's the maximum.
Maximum.
Okay, so there's no.
And how much is your income, you two?
About 180,000.
Nope, it phases out at 160.
Ugh, that's so sad.
But let me just give you a tip. Are you guys loading up your pension plans at work?
As much as I can, yeah.
Which means you're putting in 18,000?
Each of us?
Yeah.
I do. She doesn't know.
Okay, so here's the thing. If you guys are at 180, of course there's a phase out from 160 to 180, but for anyone else that's listening, it's the taxable wages that makes something not deductible because of the phase out. If you load up your pension plan, it reduces your gross income, which then would reduce your overall income because it's really being set aside in your pension plan, which then would allow you to deduct part of your student loan interest.
And I just wanted to chime in saying that if you're in this situation, you might want to get a home equity and pay off your student loans because you don't get that advantage. And
That's
so
true.
you might want to get a home equity if you can and pay off those student loans.
And the other thing is, where did you said 403B, didn't you? Do you have a 403B? Hello.
He didn't like your answer, and he got sad and hung up.
Well, anyway, but anybody that's working for a not-for-profit, like the municipalities, for colleges, if you work for New York State, if you work for a hospital, if you work for the city, if you're a teacher, that income, you're working for a not-for-profit. If you pay the prescribed amount on your student loans for 10 years, you can have that student loan forgiven.
Very good
so
point.
that's a really important point. A lot of people don't know that they can have their student loans forgiven. Okay, let's go back to the phones and talk to Jerry. Hey, Jerry.
Yes, how are you this afternoon?
Good, what's new?
Well, I was listening to the lady who said she won $800 at the casino.
Yep.
Was about having to put that on her income.
Yeah.
My understanding is that the only declarable income, if you win 50 or 100 or 200, the only time you have to declare any winnings is if you win more than $1,200 at the casino.
Not at all. No, you're wrong, Jerry. It's all taxable. Now, it doesn't mean you're going to pay taxes on it, but it has to be declared on line 21.
Ah, okay. So the 1099 that the casino generates has nothing to do with it.
Well, the casino generates when they're required to type out the 1099s, but all of your income that you win from gambling has to be reported on line 21. Then you take all of your expenses as a miscellaneous itemized deduction, not subject to 2%.
Oh, okay.
Okay, Jerry?
I don't understand 2%, but that's
okay. Well, you know what? There's a miscellaneous itemized deduction, one for 2% and one without 2%. So you as a gambler, let's say you won $10,000 on line 21, you would take 10,000 full itemized deductions as miscellaneous itemized deductions that you don't have to limit by 2%.
But the law is even if you win $2, you're supposed to declare
that's
it.
Correct. Now, I mean, in practicality, a lot of people don't, but my job is to tell you the way it's supposed to be.
Oh, then you're not bound by that 2%?
No, you don't make, it's not a 2%. It's a 100% deduction.
Oh.
And if you've been limiting it, you should amend your tax returns and put it where it's supposed to be because you got more deductions.
So what line is that supposed to be?
Schedule A. Schedule A, miscellaneous itemized deduction, not subject to 2%.
Oh.
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 So I'm glad you called, Jerry.
Okay. I'll have to look at that.
There you go.
All right. Thank you.
Thank you, sir. Bye-bye. Let's see. We're going to go to David. Hey, Dave.
Yes, sir. I've used your service for the past 2 years. I'm very happy with it. But
thank you.
I never brought up to your tax preparer is that I've owed back taxes for a number of years to the IRS. I went through a special office called the Taxpayers Advocate Group.
Yep.
And I understand that the only thing that hurts me on my credit is owing back taxes.
Yep.
I've never asked this, but does your office help to work a deal out with the IRS of lower payments and maybe take whatever you owe to make it a little smaller?
Yep. We do offers in compromise. We have an attorney that's part of our, that actually he works for us doing tax returns, and he's a specialist in offers in compromise. And if you don't have the ability to pay, then we can work out a payment program with the Internal Revenue Service, and they will accept much less to pay up the obligation. So we're happy to help you. So when you go into the office, just have them refer to you, and we'll make sure that he gets back to you to do the offer and compromise.
Well, thank you very much.
Right.
Your office on French Road in Cheektowaga.
Yeah, then we'll take good care of you, Dave.
And at least make sure you set up a payment plan, too, so that you can try to get this off your credit.
Right.
And how long would it take to get? If I'm in this payment plan, would that come off my credit?
No. Okay, let me ask you this: do you have assets, Dave?
In what form?
Well, I mean, you got a house, a car, you got a pension.
I'm paying on, and I rent.
All right. So, do you have a pension?
Yes.
All right. May I ask approximately? Is that pension money like in a 401k?
No.
Is it a company pension that you can't get your hands on?
Yes.
Okay. So basically, you don't own a home, and you don't have any assets?
The car.
Except for the car, right?
Correct. No.
And does the car have any asset value?
Yes.
A lot or a little?
A little.
Okay, so you really don't have any assets. So you're a perfect candidate for an offer and compromise, okay? As far as the payment program, it's not going to get rid of the back tax issue until it's paid, but the offer and compromise will.
Okay. Well,
okay?
Thank you very much.
All right, thanks, Dave. Bye-bye. Okay, and we're going to go to Linda. Hey, Linda.
Hi.
Hi.
Thanks for taking my call. My sons and I love going to Maria every year at tax time.
Oh, thank you.
Here's our problem. My one son has gotten a job with the federal government. He has great benefits in the sense that there are IRAs.
That's true.
The problem is, up until now he's 25, 26, he's had a small IRA started with a company, with a financial advisor. The problem is he's trying to get it out of the financial advisor and liquidate it to get it over to the federal government. And supposedly the HR at the federal government office said, you have to actually take it out of where it has been with your financial advisor and put it in savings or an account, and we will withdraw those the Roth IRA payments from there. Is there going to be a problem if he takes it, liquidates it, puts it into his account, and then as the federal government withdraw these amounts for their Roth IRA
Okay, so the only thing that's not going to be taxable is if the rollover takes place within 30 days. I think Tiff talked about this at the beginning of the show. So the money has to go from him to the new IRA within 60 days. Now, so if he withdraws the money from where his financial advisor has it and puts it in whatever account they said it has to go in, and then they take it out within 60 days, there's not going to be a problem. So it all depends on how quickly they take the money out of this account they want you to establish to put into the government account. So he should find out how long it's going to take.
And then I was really concerned when you said Roth, because when you convert something to a Roth...
No, it is already in a Roth, isn't it, Linda?
It is a Roth.
It's a Roth. Yeah, going to a Roth.
Okay.
So, but the thing is, even though people are in a Roth, what they aren't aware of is that if you take money out of your Roth IRA and you're under the age of 59 and a half and you haven't had it in for and after that haven't had it in for 5 years, the growth is still taxable. So the best thing to do is for him to find out how quickly is the government going to withdraw the money. If it's going to take more than 60 days, it'll become a taxable event, or part of it will be a taxable event to him.
Now, the other question, speaking of the Roth, he claims he can hold more out than, is it $5,000 or $5,500 for?
Well, but if he's working, if he's an employee, he can put $18,000 away.
In a Roth?
In a Roth pension plan, in a Roth 401k or 403b. It can be a Roth IRA is limited to $5,500 if you're under the age of 50, $6,500 if you're 50 or older. All right. A traditional IRA, $5,500 under age 50, $6,500 over 50 or older. Okay. A Roth 401k, $18,000. Okay, a regular 401k, $18,000.
So a Roth IRA where he has tax dollars taken out of his paycheck, like I can do 65 because I'm playing catch up because I'm over 60.
No, you're talking about apples and oranges. One is through his employer, and the other one is when you're an employee and you set up your own plan. Yours is an IRA. His is a qualified pension plan at work.
Okay.
We need to talk when you come in the office.
Yeah.
Thanks, Linda. Bye-bye. Yeah, because we can spend all afternoon here. Okay, we're going to go to Jenny. Hey, Jenny.
Hi. I have a question. I was in your office last week to do my tax.
Yep.
I'm 83 years old, and I'm just on Social Security, but I have two IRAs, one IRA annuity, and the regular is just a regular annuity, lifetime life insurance annuity. And I'm wondering, I want to withdraw from that yearly now. So what can I take?
Oh, it's all based upon your actuarial tables. So what I'd suggest
do you mean how much you can take before it's not taxable?
Yes.
We'd have to look at your tax return.
She mentioned she just had Social Security. Do you take anything out every month besides Social Security?
I just have Social Security, and I have to withdraw from that IRA month.
She's doing an RMD.
Okay.
Yeah, so what I'd like you to do, Jenny, is call the office. We'll look up your tax return, give you a specific a number, okay?
Oh, that'll be fine.
All right, thanks, hon. Bye-bye. And then, Mike, how can we help you?
Yeah, quick question. I have two granddaughters. Two of them are working. What's the most beneficial way with my son doing his taxes? Do they claim their...
Well, all right. The kids are how old?
18. They just turned 18 in January.
Okay, so the kids are going to be claimed by... Who do they live with? You and the father, or just the father?
They live with the father and the mother.
All right, so it's going to be the dependent of mom and dad, plain and simple.
That's
and
the best
that's
way.
It.
Okay, so what about what they've earned?
They do their own returns. They don't claim their exemptions. Mom and dad claim the exemption.
Mom and dad, okay, because it's beneficial to my son, right?
I mean, I'm assuming your son makes a decent living, right?
Oh, they're over 100,000.
Yeah, so it's going to be in the best interest for mom and dad.
Okay, all right.
Thanks, Mike. Bye-bye. I'm Esther Golias, the tax lady from EG Tax. If you need the best tax help for the lowest fees, we want to help you. Give EG Tax a call. And until next Saturday, I'm Esther Golias with Tiffany Fabian. God bless you. Bye-bye.